So, you're probably wondering, how can a war happening thousands of miles away possibly affect the price of a house right here in your neighborhood? It feels like it shouldn't, right? But it absolutely does. Today, we're going to untangle that very real and pretty surprising connection between global conflict and the US housing market. It really wasn't that long ago that things were looking up. The spring home buying season was actually shaping up to be pretty great. Price growth was finally starting to chill out, more houses were hitting the market, and mortgage rates were trending down. Honestly, there was a ton of optimism in the air. And then, boom. Almost overnight, all that optimism got tossed right out the window. A single, powerful new variable got thrown into the mix, and it changed pretty much everything. If you had to boil down the current housing market to just one word, this would be it: uncertainty. It's like a thick fog just rolled in, and now it's incredibly tough for buyers and sellers to see what's coming next. So let's start there. Let's look at how the entire mood of the market went from hopeful to, well, basically holding its breath. I mean, just look at the difference here. Before, the vibe was optimistic. Now, uncertain. And we're not just talking about numbers on a spreadsheet. This is a huge shift in how people are feeling. Joel Berner from Realtor.com really nailed it. The conflict created this new cloud of anxiety. For sellers, it brings back something called the lock-in effect. Think about it. If you got a super low mortgage rate, why on earth would you sell your house and risk getting a new, higher rate in this kind of environment? It could totally stop people from listing their homes, right when we need them most. All right, let's talk about the thing that hits your wallet the hardest: mortgage rates. This is where what's happening globally really hits home, literally. So on March 1st, the average 30-year fixed rate was 5.99%. And that number is so important because it was the lowest we'd seen since last September. The trend was finally moving in the right direction for home buyers. But just 2 days later, it jumped to 6.13%. Now, that might not sound like a massive leap, but what's crucial is that it completely reversed that good downward trend we were seeing. It was a financial shockwave, and it was tied directly to this new global instability. So, why the jump? Well, it's not as simple as you think. What we're actually seeing is this really complex economic tug-of-war, with some massive forces pulling rates in totally opposite directions. So on one side of the rope, you've got everything that's pushing rates up. That's your classic inflation fears, rising oil prices, messed up trade routes, stuff that makes everything more expensive. But pulling on the other side of the rope, trying to drag rates down, is this interesting thing called a flight to safety. Basically, when the world gets scary, investors rush to buy up US Treasury bonds because they're seen as super safe. When tons of people buy bonds, their interest rate or yield goes down. And since mortgage rates tend to follow those yields, they can get pulled down too. The problem is, right now, the inflation fears are pulling harder. And here is where it gets super tricky. That whole flight to safety thing that could lower rates, it's driven by fear that the economy is slowing down. But a weaker economy could mean a shakier job market. So sure, rates might come down, but what good is that if you're suddenly worried about your job or can't afford to buy anyway? It's a real catch-22. So with this economic tug-of-war going on, the million-dollar question is, which side is going to win? Well, according to economist Lisa Sturtevant, it all comes down to how long this conflict lasts. She's mapped out 2 totally different paths for the housing market. Okay, so path 1 assumes the conflict is short-term. If that happens, we probably see a temporary spike in rates, the spring season gets delayed a bit, but then things bounce back and prices stay pretty strong. But path 2, a prolonged conflict, that's a different story. That could mean higher inflation and higher rates stick around for a lot longer. Consumers get more cautious, the market slows down, and some buyers might just tap out for a while. Okay, so with all this uncertainty and all these competing forces, what are you supposed to do? How do you even begin to make a decision in a market like this one? I think this quote from Mike Simonson at Compass just cuts right through the noise. This whole situation is just the latest reminder that trying to perfectly time the market is, like he says, a fool's errand. There is always going to be something new and unpredictable around the corner.
So if you can't look at the global headlines for a green light, what is the right signal? What should you be looking for?
Well, according to the experts, it all boils down to 2 really simple, really personal questions. Number 1, do you love the home? And number 2, can you actually afford the home? If the answer to both of those is a solid yes, then that's your signal. If not, don't let FOMO push you into a decision that isn't right for you. And one last thing to keep in mind here. beneath all this new uncertainty, some of the market fundamentals are still pretty good. As economist Sam Williamson points out, the underlying demand for housing is still really strong, and inventory is actually better than it was this time last year. People still want to own homes. So I'll just leave you with this thought to chew on. In a world that is constantly going to throw new things at us, from pandemics to wars, maybe the biggest risk of all is just waiting on the sidelines for a perfect, certain moment that might just never show up.